Good morning, ladies and gentlemen. Welcome to today morning's panel discussion. As you just heard, we'll be discussing the following topic, which is e-commerce play in India. Too expensive a bet or futuristic investment at a nominal price. So you've already met the panel, and we have about 45 minutes for the discussion. We propose to have a discussion for about 30 minutes and then spend about 15 minutes answering any questions that may be there. Without much ado, let me straight away get into the discussion where hopefully we'll discuss if indeed the valuations are expensive, what are the trends in the industry which are driving those valuations, what are the fundamentals, and if indeed there are some issues that could derail the story. So let's start the discussion. And Avnish, if I may start with you. You've been an entrepreneur and you're an investor now. So you could bring an interesting perspective to this topic. As we all know, we have 45-50 million active users today. The GMVs are relatively tiny, but still in the billions. So it is fair to say that you can't ignore the phenomena, but also it's also fair to ask if the valuations are justified today. And are we really, at an inflection point, or are we witnessing a momentum play here, Avnish?
I think it's on now, yeah. Good morning, everybody. So if the valuation is low if we are already invested in the company, and it's high if we have to invest in the company. That's how we think about it. It's just a joke. So if we meet an entrepreneur, the valuation is always low. If you meet investors, they're always high. And the reason, in my mind, so I think just giving a little bit of a historical perspective is that this story has played out before a number of times. The difference this time, and honestly it's the first time that it's happening in this fashion, is that there is a market. So in the past, it was clearly a bubble and it was very easy to call because there were no fundamentals. So we used to say, valuations devoid of fundamentals is very easy to call as a bubble. This time it's a little harder to call, which is why you'll hear a lot of VC speak. And when you start hearing VC speak, you can assume that it's a bubble, but you'll hear the difference between bubble and froth. Froth is when valuations are high, but there is fundamentals. Bubble is when valuations are high and there are no fundamentals. The reality is the valuations are high. I think the simple answer to the question is, it is a futuristic investment at a very high price. So it depends on how much do you believe in the future. But if you take one perspective, I was just asking Prashanth on the GMV of Flipkart, which for all practical purposes is sales. So, and I'm sure there are some offline business people here and I may be getting myself on the wrong side of them, but the reality is, if you sum up the total sales of Reliance Retail, Pantaloons, all these organized offline players, I believe Flipkart, Snapdeal and Amazon are probably 30 or 40% larger than them. In how much time have they gotten there? Probably in the last 3-4 years. In how much time have all these other companies gotten there? Probably in 20 years. What will be the size next year? These guys will be probably more than 2x the size of all these offline organized guys combined. So this is serious levels of disruption. And when serious levels of disruption happen, greed happens. And we are living through a greed cycle. It's very hard to price it. And price is, its beauty is in the eye of the beholder. So price is however excited you can get the investor. But I don't believe that it's overpriced 10x. If at all, it may be overpriced 2x. 3x maybe, but it is very high price. And and later in the panel we'll talk about what the downsides of those kind of pricing are, because it essentially, in our kind of a parlance, it takes the margin of safety down to zero. And in my case, I believe in currently there's no margin of safety in some of these things. So if things go wrong in various ways, it becomes a problem. But I think we are living through, I'll give you one last statistic and then I'll pass this on. What is often missed is, you mentioned, Vikas, 40 to 50 million internet users. 3G users are about 70 to 80 million. In the next 3, 4, 5, 6, 7 years. Who knows? I have no idea. Is it 3 or 5? I don't know. What I do know is that it will get to 500 million. That kind of a 5, 6x multiplier at scale. See, 20 to 80 is also 4x multiplier, but it's at subscale. 80 to 500 is at scale. That kind of multiplier happens once in the lifetime of a country. Once in the lifetime of a country. We are going through that right now. So when we see all these hedge funds coming, all these prices going up, whatever, there is a lot of greed around it, but they get it. That happened in China in the last 7 years. 70 to 100 billion dollar plus companies got created in China in the last 7 years. So we have just entered that phase. So that's so there is a lot of greed, there's a lot of froth, but there is an underlying reality as well.
Thank you, Avnish. So Prashanth, Avnish spoke about the future growth potential of the country. It's, the fact of the matter is that e-com in India is still at fairly nascent growth story. So while we can justify valuations on future growth, but in terms of the kind of valuations investors are giving, do you believe they are discounting all the risks properly? And are there some categories within e-com, and Avnish really spoke about, I would guess, horizontal marketplaces, but are there some categories within e-com which you think are fairly overvalued even today?
See, I think the story will largely still play out in the horizontals from a scale perspective, right? So some of the verticals like furniture, which Ambareesh will talk about, I think you will see some of these break out. But if you just take the proportion of GMV that will be generated by these horizontals, it's still the big story. I think Avnish fairly summarized everything that is driving these valuations. The only thing I'll add is that the velocity of this growth, right, is something that everybody is factoring in. And if you see the Alibaba playbook, the Alibaba playbook is something that everybody is seeing now. And just 6-7 years ago, JD, which is now a $38 billion company in China, had $20 million in GMV 7 years ago, right? So, and today China is about 400 odd billion dollars. US is around 300, and let's assume India is around 10 billion, right? So you're talking, no matter how pessimistic you would like to be, for the reasons Avnish was saying, whether it's smartphones, millennials, the next 40 million millennials coming into the workforce, any of these, India getting to 100 billion in GMV is a given, in our opinion. I think the risks for saying India will not get to 100 billion would mean that our middle class will stop consuming, would mean that there'll be no new job growth, and would mean that for some reason, while technology and other platforms will help these e-commerce companies to scale, first, just like the constraints in offline retail didn't allow some of these folks to scale, will there be other things that will slow down, maybe in logistics infrastructure, maybe some other. But outside of these, which are very, very small risks, I think it's pretty much, you can say that 100 million is not outlandish to expect. And there's this 1:4 China-India factor, so you put that. I mean, you put whichever lens that you want to. I think it's reasonably predictable that you can get to that scale.
Thank you, Ambareesh. Prashanth spoke about the kind of growth and the kind of expectations we have, but one question that I wanted to ask you, from the viewpoint of an entrepreneur, the kind of valuations we are seeing today in India, and I would say the kind of valuation growth, you do one round at a certain valuation, do the second round within 6 months at twice the valuation. We've not really seen this before in India. So perhaps, is it a situation where experienced investors who've experienced this story, let us say in other geographies, China, US, those are the guys who recognize a pattern and are coming to India and investing. Is that the situation here, or do you think this is really, again, something where, if I may use the phrase, land grab in anticipation of growth?
Sure. Hi. Yeah. So this might seem tremendously self-serving, but I think my point of view is a little slightly different. I fundamentally believe that money needs to grow, right? That's the nature of banking. That's the nature of investment. That's the nature of everybody who has money wants to have more money, right? I think in the context of e-commerce today in India, there are organizations, there are companies that have been created, startups or now proper companies, large companies, which actually have relevance to the consumer. And that hasn't happened ever. Like Avi said, it's not happened ever in the last 10 years. Today you have the odds of an Indian consumer having their first interaction with organized retail through an e-commerce store actually are far higher. I mean, the odds are that the first interaction is actually with an e-commerce store as opposed to with, let's say, an organized offline retail store. And so therefore there is tons of relevance. So if you take these two things in context, right, you think fundamentally money wants to grow, right? And you say relevance of e-commerce as a sector is high. I think the question that comes up is, what's the price for disruption, right? And it's the price of disruption that drives what valuation companies should or should not expect. You could, for example, have a very low valuation for a company which is doing really well and steady in a business which is not e-commerce. And if e-commerce is going to disrupt that company, then you would want to ensure that you're insured in terms of playing a bet or taking a bet on a company which will eventually disrupt whatever exists today. And I think that's part of what creates the valuations, right? Now this is not a new pattern. It's not something you see only in India or you've seen only in India. To your question specifically, this pattern's happened across the world. And there are investors across the world, there are investors in India who've seen this pattern either as entrepreneurs, as investors, as watchers of the market. And I think they're recognizing that pattern playing out in India. So it's, in my view, valuations for businesses should be, and I think are in today's world, based on underlying value that those businesses have created, the relevance that those businesses have created. Whatever is the multiplier effect comes courtesy the premium that you pay for disruption, right?
Great. Sundeep, we've been talking about the kind of valuations investors are attributing to e-com companies, allegedly expensive. But what about the companies themselves? If you've seen some of the M&As in the past, they are, practically acquiring each other at relatively similar valuations. So is this proof that the valuations are real, or do you think this is just another trend where companies are trying to grow bigger in size to maintain GMVs, to grow GMVs and attract more capital?
Well, I actually have a slightly different take on the entire thing. About 4 years ago, on a similar kind of a podium, the question was, can e-commerce take off? Till about 2 years ago, the same question was being asked, now how much of it is really real? In 2 years' time, you can't get down to a question saying, are the valuations too high? I think we're jumping onto this a little too quickly. Yes, it's like any other asset class. It will go through some kind of a correction. It's like saying 7 years ago, buying a piece of real estate in Bombay at 10,000 rupees a square feet was very high. Today in the same area, you're buying the same property at 40,000 square feet and there are people still investing. In India, I think it's a little too early to start talking about valuation. I think what's truly happened is, and this has only happened, see, the idea of a virtual retail started by a handful of people about 7 years ago, 5 years ago. The question of coming into its own and building a real business has only happened about 2 years. Today, the good thing is that nobody is talking about it being, will it happen or will it not happen? I think it's a reality. In a country like India, 100 billion is a guarantee. It has to happen. Even 100 billion, I think, is a slightly conservative estimate. And I have I mean, the reason I'm saying that is this business or businesses that have got developed have actually got developed because of a handful of investors who believed in this domain and a handful of entrepreneurs who believed that you could build these businesses. But other than these handful of people, nothing else has changed. It's fundamentally a virtual or an alternative distribution platform. Our ecosystem hasn't changed. Our physical retail hasn't changed. Our logistics and infrastructure hasn't changed. Our government regulation hasn't changed. So there are so many catalysts which are going to change now, which are going to take this industry to a, a multiple level. So from my point of view, I think anyone who's thinking that this is high valuation, yes, that's a very individual perspective. It will go through corrections. Also, we are forming opinions basically because of one or two companies. The industry is still to be built. So I won't question. Yeah, I mean, you can debate on valuation because honestly, as an entrepreneur, I still don't know how valuations are done. I really don't. But if they're high in one area, great. But I think there's a huge potential of growth.
I understand. You're basically saying that with the structural change, the story may have just started in some sense.
I'm very confident about that.
Understand. Okay, great. So let's talk a bit, let's do one round of questions, talking about some of the trends that the businesses are seeing. And Prashanth, if I may start with you. Your portfolio companies, Flipkart, Book My Show, they've done M&A in the past. Do you see that as a trend continuing? And if you could share with us what exactly is driving this? And we've been talking about high valuations, and typically in other sectors you don't see really situations in high valuation environment, there being a lot of M&A, but do you see it's going to continue?
Yeah, it's an interesting question. I think there's two parts I'd like to talk about. One is just entrepreneurs today seem to be willing to move on and say that, okay, if I get to be part of a larger platform, let me take it. This is not my last entrepreneurial stint, and do that quickly, right? And so I think the whole velocity and the momentum of wanting to build fast drives some of these entrepreneurs now to be more open about being part of a larger platform and riding the larger platform. The second part is Indian entrepreneurs never valued other companies, like what you see some with Flipkart and some of the newer companies. They're actually willing to pay a reasonable price, and really, I think this is a trend that I would say you will see more of. There are other trends that have played out, but I think the whole consolidation and the smaller entrepreneurs who have built a company to a particular scale now wanting to. So I think you'll definitely see more of this trend.
Great. Avnish, we often speak about GMV as a metric when it comes to valuations. Is it something that companies either through M&A or through other strategies, is it something that they can really protect over the longer period of time?
I don't look at it that way. I don't think the companies necessarily look at it that way. I think let's talk about GMV as a metric, because when people talk about GMV, it's worrisome sometimes, and it's sometimes an indicator of a bubble. But I think for the audience in this room, and Sundeep mentioned that sometimes it's hard to figure out valuations. The only reason GMV is being used as a metric is because the rest of the business model at that moment of time is unclear or hasn't played out. But there are steady state views of that business model that investors take. And so let's just do some very simple quick math, right? If you have 100 in GMV, let's say you are taking 10% as commission, you have 10 in revenue. What investors project is typically these businesses, when they take 10 in revenue, what kind of profit after tax can they make? Can they make 15%, 10%, 20%? And what price earnings ratio, which is the language that is normally used, would get ascribed to it? You multiply that and then you back into therefore what GMV multiple. Now typically if you do all of that, it will come to 1 to 2 times. Currently companies get valued at 3, 4, 5 times. Why? Because they are growing more than 100, 200% year over year. That's the growth premium. I think looking at M&A, I basically agree with everything Prashant said. I think the key point to understand, and in fact we were discussing this internally yesterday in our team meeting, is Indian businesses have been domestic M&A has never been a great option for any entrepreneur as an exit, because Indian entrepreneurs are cheap, historically. They never pay up. So M&A was generally a distress sale. That's not the case with the new breed. The new breed is very fearless, they are very ambitious, they want to create very large businesses. So they are not necessarily buying GMV, they are generally buying some strategic complementarity or buying scale. Not necessarily just for GMV purposes. But I think there's a big inflection point in the market where domestic M&A at market prices will be happening more and more.
Understand. Okay.
Can I just
Sure,
add to
of
that?
course.
Listen, as somebody who's tasted entrepreneurship, one reality is you can't do everything yourself. And it's best that you realize it. And there'll always be somebody who's doing a component of your business, which could be a support to your business, who's doing a far better job, a far more focused job. The idea is to really co-opt and scale up and use the opportunity. So I think M&A is a great thing to do, because there are so many people. You know, not everyone will be able to make a horizontal marketplace as successful as an Alibaba or a Flipkart or a Snapdeal or an Amazon. But there'll be a lot of guys who can do a lot of support businesses, which can be part of your entire ecosystem. So M&A, I think, is the way forward.
If I could also,
Sure.
if I could also, hi. I think there are three aspects to this. One is, of course, the financial aspect, which is often drives decisions. I think the other aspect of M&A, and typically great M&As work out when the cultures of two companies are similar. And especially because this is a new breed of companies. Culturally, you'd find similar people working in organizations. And normally successful M&As require require more or less homogeneous cultures to come together. So that's why you will see M&A as a trend. And the third aspect, and I just want to say this as an entrepreneur, I think it's the bet you take on the business that you're in. And it finally boils down to the following. Do I think in the longer term, my business will be having significant competitive advantages which anybody else cannot surpass? And if that is a bet that the entrepreneur takes, then sometimes M&As take longer, or entrepreneurs stick it out and so on. Or if the question is, no, I might not have as much defensibility, then of course M&A is an option. So I think these three factors are what drive it. The first two are exceedingly positive, and I think that's a great sign for M&A in India. The third is normally a decision that the business needs to take on the faith that it has on whether it's built the moats out, it has defensibility, etc., etc.
Excellent, Amrish. I think the point you talked about, the culture of the two organizations being compatible, is very, very important, as you've seen in numerous M&As playing out. But ladies and gentlemen, we have just enough time to do one last round of question from the panel. So I'll straight away get into some of the risks and tripwires, and also a little bit, we are very close to the budget, so let's talk a bit about that as well. So, but let me start with Prashanth. Prashanth, whenever you invest in a company, obviously valuations are also driven, and the decision to invest is driven by an exit. Now, M&A we spoke about whether it's a suboptimal or optimal exit, but in terms of a public market exit, do you have concerns about Indian markets or even US markets, notwithstanding a lot of successful examples, being able to absorb Indian growth stories at the valuations that we are witnessing today?
No, actually, to the contrary, I think there's a big opportunity being lost in the market here to actually tap into this growth, right? We've been hearing some noises of changes in the regulatory ecosystem for listing and so on. There's probably couple IPOs that you will see in the next 2 to 3 years globally, right, which may further accelerate opening up and changing people's, I mean, so I think something dramatic has to happen where, you know, what could have otherwise been potentially the next, you know, 20, 30, 40, 50 billion IPO from India is actually happening from NASDAQ, and the Indian retail investor or the Indian stock market has totally lost out that opportunity. You'll need to see couple of these. That's like the worst case. But the best case, what we are seeing is in the next 18 months, you will see some significant regulatory changes in the potentially in the regulation, which will allow this whole pent-up demand for internet stock in India to be actually played out. So I think some interesting things could play out there in the next couple of years.
Understand. Ambareesh, if we can talk a little bit about what could drive growth even more. And one thing could be technology infrastructure, physical infrastructure, you know, especially in your segment, logistics and distribution. Do you think, and you know, in terms of FDI regulations, what role could that play, you know, in improving the growth story here?
So when we started off, one of our biggest challenges was the fact that, so in our industry, right, furniture and home products, we actually don't have a established distribution network. So it's not like, say, mobile phones, where there's a distributor in Bombay, Delhi, Nagpur, Nashik, etc., etc. So the buyer in all of these cities can actually get goods from that city. That doesn't exist in something like furniture. And so therefore the entire aspect of moving goods across long distances, doing it in a manner which is efficient, cost efficient, all of that, was something that was a challenge that we contended with. And therefore we had to build everything from scratch to be able to actually deliver a 100 kg wardrobe, which has traveled 2,000 kilometers, up 9 stories, 9 floors in a flat of a end consumer, was a challenge. And that logistics, etc., was what we built. The thing that we would really think will drive growth forward is if we stop treating India like a bunch of small countries. It's when goods move across states, they should move peacefully. There should be transparency in paperwork. Nobody, I think, in the industry does not want to pay whatever tax the government levies, right? It's just that we want clarity. We want to know that we will be able to sell products across the country, in all states across the country, on terms which are clearly known to us, and therefore, you know, we're able to comply with them totally. So something like GST, I think, will be a huge driver. You'll see interstate goods movements like truly shine. And that's what e-commerce is all about. I think there is a lot of investment already in the sector. I know that there will be a lot more that will come in. There will be regulatory changes from an FDI standpoint. There will be regulatory changes to allow for the retail investor to participate in the growth of these companies and therefore truly build wealth for the country. And I think all of those will pan out. They might take 12 to 24 to 36 months to do so. But I think some of the more operational changes, which are investments behind, you know, our infrastructure, investments behind a uniform method of taxation across the country, those will drive business growth and transparency substantially over the next couple of years, and you know, therefore one looks forward to all of that coming to fruition over the next few years.
Understood. So Sundeep, Ambareesh pretty comprehensively covered a lot of you know, expectations, but anything that you would like to add, especially given the budget, any expectation that the industry would have from the you know?
Well, I think he's just really covered it. There are only two things. If there can be clarity on FDI, and if there can be clarity on GST, nothing could be better for the industry. Ambareesh is absolutely right. The biggest bane at the moment is movement of merchandise across the country. There needs to be transparency and there needs to be a cohesive strategy on what the taxation is. Right now it's difficult to move merchandise from Delhi to Noida, which is absurd. So I think if something like that comes in, my only scare and fear is that so much has been spoken about it, but some of these decisions are more populist decisions. E-commerce really, I don't know whether it sits in that populist sort of a mindset, but it is a must. It is a must.
From a job creation perspective, certainly.
Well, it's from a talent creation, it's a job creation. Fundamentally, e-commerce is nothing. E-commerce is just an alternative distribution platform to get merchandise, services distributed across the country, which the physical infrastructure doesn't or can't do. So there's no question about it.
Okay, so great. I've got a bunch of questions here from the audience, but before that, I'd like to give the panelists, 30 seconds each to just sum up the discussion, or to add anything that we may have not covered.
I'll just make a point on this government thing. I have very low expectations. I hope they just don't screw it up. I think that's the best they can do. This industry has grown because they don't know what this industry does. I hope they live like that for the next 5 years. We'll be okay. Every time they try to do something, they screw it up.
Okay. Right. So, Sundeep, starting with you, could we just have a summary of what you think, say in 30 seconds? Anything that you may have left out you want to cover?
No, I think e-commerce is good. Virtual retail is here to stay. I still think this is early stages. It is going to become an industry. For the first time, I think being an entrepreneur and even a failed entrepreneur is good on your CV. So I think it's a great one.
Avnish?
Not much to add. I think I would just take off from where Sundeep is. I was an entrepreneur in India 15 years ago. I have never seen this kind of a network effect that we call. So the young 20-something entrepreneurs, funding ecosystem all the way from angel funding to late stage where you can exit, deep markets. So it is just an awesome time. Forget the valuations. They likely go through a correction. At some stage it will seem like it's a nuclear winter, but it's not. This is the true beginning of what has happened in Silicon Valley. It has started to happen in India over the last 2 years.
Excellent. Prashanth?
So I think very well summarized already. So the only thing I'll say is, the opportunity here is we said, okay, I'll go back to my 100 billion size. 100 billion GMV or whatever size would mean a 200 billion market cap, right? So you're talking about 10, 15 companies, billion-dollar companies that we don't even know of today. So the opportunity, like what Sundeep was saying, for entrepreneurs is like never before.
So I wholeheartedly agree with everything that's been said. I think that there are several great businesses being built in India today, and I think we will see a lot more great businesses come up over the years to come, and I think exciting times ahead.
Thank you. So let's, we've got about 10 minutes left, so let's get into the questions. The first question I have is from Vinit from apnastock.com for Ambareesh. So the question is, what was the one big thing leading to your blistering growth?
I think getting our supply chain right. So we have a very different market that we serve. Our sellers are exceedingly fragmented. There are so just to give you context, the top 5 brands of mobile phones in India have 60-odd% share of the entire market. The top 5 brands of shoes in India have about 80% share of the overall market. The top 5 brands of home and furniture, which includes retailers, have 4% share of the market. That's the level of fragmentation that exists in home and furniture. And therefore, our biggest challenge was how do we get supply from an exceedingly fragmented supplier base? How do we get products to customers who are spread out across thousands of towns in India? And how do you do that in a manner where the cost of getting the goods across to them is not prohibitive? So, and I think that's what we cracked. Pepperfry is a very interesting company. If we have 100 rupees to spend, we spend our first 70 rupees in supply chain. We spend our next 10 rupees in merchandising and category management. We spend the next 15 bucks in technology and in product. And then when you have $5 left, we use that and do marketing with that. So, our focus and our objective at all points in time is to have a really robust supply chain going. And I think that's what cracked it for us.
Avnish, this is a question for you. It's got to do with raising capital at a very early stage. So the question is, investors don't invest any money at the idea stage. And how would an entrepreneur, raise funding without proof of concept?
Investors do invest money at the idea stage. We've invested in a number of companies at the idea stage. One of our investments is a company called LimeRoad. In fact, the person we invested behind, she hadn't even moved back to India. It was just pure idea, pure vision. So I think if you're getting if that is the impression, that's incorrect. What often happens is people mismatch the stage of their business with the stage of the investor they approach. So if you're at an idea stage, the right investor is angel investors and seed funds. Some VCs very, very selectively are doing it. People like us are doing it. Accel does it. But still the wrong people to approach, my view. Because you have to go with where the chances are the highest. And the chances are the highest are at seed funds and angel investors. Once you have a product out, that's a Series A, that's a VC. Once you have some traction, that's a Series B. Once you have scale, it's Series C. So what often happens is people approach the wrong investors for the stage of their business and they end up getting disappointed. That's not the case. There's plenty of money available at each stage, and that's one of the big changes that's happened in the Indian ecosystem.
Thank you. This question is not posed to any particular panelist. The question is, what keeps you awake at night? Key challenges to achieve the $100 billion dream. I'm assuming the two are related. So, Sundeep, do you want to take a crack at that?
I actually sleep pretty well, so but there are lots of things that keep you awake. Retaining talent has become one of the biggest things that keeps you awake, with suddenly so much of an activity and a very little pool of talent. And if you're the first mover, then you have the talent that gets poached. So at the moment, that's what's keeping me awake more than anything else.
Right. Prashanth, for you. The question is, at what level of GMV sales do you believe the industry can turn profitable?
Well,
sorry, there's a related question. How do you factor market dynamics, competitive landscape vis-a-vis the discount war?
okay. So on the first one, it's really category dependent, right? So Ambareesh will tell you that there are certain categories where you do have a lot of play and a lot of flexibility. I think apparel is one. We believe furniture, jewelry, all these categories, and most of the horizontals today are very focused on smartphones and electronics, and that's just the nature of what is selling. But at the same time, if you need to really differentiate yourself, then like Ambareesh said, you need to pick a space where your dynamics in the market, either being an internet-first brand or a very, very fragmented market that you can kind of really play out well. Now on this, what was the second question?
How do you see the discount wars playing out?
No, actually, I think the good news on the discount war was I think it's no longer really about discounts, broadly. I think the first generation of horizontals or even the other e-com players, I think there was a heavy dependence on discounting. But I think people are moved beyond that. I think people are getting smarter. They know there are other elements that matter when they pick a brand. So you will see that. I think that's while Indians are value conscious, there are all those. So Ambareesh, maybe you want to add a little bit, because I see some positive trends in this. The whole discounting thing actually not mattering as much as what people feared it would be.
Actually, I totally agree with you, Prashant. So when you think about discounts, etc., you should think of two things. You should think about, are your fundamental unit economics on every item that you sell, does that make you money? And the second part is, how much do you invest behind customer acquisition, growth, etc., etc. As long as you're making money at a unit economic level, it's fine. You can deliver value through discounts, you can deliver value through advertising, you can deliver value to get more folks in through the funnel. And I think that trend is now fairly robust, and it's going to be about using all the possible marketing levers that you have in order to acquire as many customers as you can. if you were to ask me the question of whether discounting is a role, I mean, is good, bad, or whatever, I think businesses have a duty to increase shareholder and stakeholder value. That happens by virtue of having more customers come and buy from you. More customers come and buy from you because of multiple things that businesses do. By providing differentiated products, by providing them at the right price, by being available when the customer wants the product, by delivering fast, by delivering as per committed timelines. All of those things are things that businesses have to do as their duty in order to grow. And if discounting is one of the levers that they use, so be it. I mean, that's fine. I mean, I think we spend too much time thinking about it. It's just one of the levers that businesses use.
Maybe there's just one quick point I'll add. I think there is a lot of play in the data that is available today, which allows businesses to be a lot smarter. So while there are so many other dimensions that will differentiate how traditional retail performed in delivering value, I think the use of data will dramatically shift how that whole value is directly realized by the customer.